Good morning, everybody, and welcome to our class today. I'm Shawn and I am the business advisor for the Minority Business Assistance Center, and we welcome you to our session. We have with us today Renee Tyack, who is going to be presenting to us today on Factoring 101. So let me tell you a little bit about Renee. She has grown up in the cash flow business. Um, Capital Plus was established in 1992 by her father and specializes in helping businesses streamline the revenue cycle and balance cash flow via customized accounts receivable management and financing programs. And Capital Plus has served more than 1,500 businesses, funded over $1 billion in capital to B2B companies nationwide, and that they are now a division of United Capital Funding Group, a subsidiary of Gulf Coast Bank and Trust. Renee holds a bachelor's degree from Denison University, and has also studied abroad. And she's active in several organizations, including as the education chair for RMA Central Ohio, co-chair of the Women in Transactions, ACG Columbus, an active member of the Secured Finance Network, the Women's President Organization, and Golden Seeds. And she's also been featured in the 2009 premiere edition of the Women's Book, Columbus CEO, the Columbus Dispatch, Business First, Forbes Book Radio, and is also a guest on B2B Radio with Mr. Biz. So we have a celebrity in the house today. And so we're just glad that she's able to take time out of her schedule to share with all of you. So I will present now to you Renee Tyack of Capital Plus, and she will take you further.
Thank you. Thank you. I appreciate that. So I will cover, for everyone's benefit, an overview of factoring. And then please engage and let me know what questions you have. Even specific questions. I really want to be a resource for you and answer. This is a very intricate offering. It can be very complicated for business owners. And so the better you understand it as a business owner, and those who work with advisors are far more successful at using this for sustainable growth than someone who just jumps right in without really understanding it. So my goal today will to be really to just present this, the various aspects of it, and then serve as a resource for you if you have questions moving forward or through the presentation. So please interrupt me or put a question in the chat. Again, my name is Renee Tyack. I'm with Capital Plus, and I'll be discussing factoring, giving you an overview. Let me see here. I want to make sure I'm moving this properly. Sorry, there's always something. As Sharon said, I am with Capital Plus, founded originally by my father in '92. Thrilled to say that we have really some wonderful clients who have been with us for the long term. And I'll explain why that makes sense. But we were acquired in 2019 by United Capital Funding. And to give you a little perspective there, I really love doing presentations like this because I've been the business owner. We've had those moments where we've thought, okay, how do we bridge our own gap? And how do we capitalize our own business? United Capital Funding was founded by a very good friend of mine. He and I really grew up in the business together. He was a good friend of my family since the 90s. And so for us, moving into a partnership with United Capital Funding was beneficial in so many ways. It provided us an opportunity to recapitalize our own business. It provided us an opportunity to compete in the marketplace better because versus being investor funded, we were now going to be bank owned. So our cost of capital was reduced, allowing us to be more competitively priced for our clients and prospects. It also allowed us to improve our technology. Technology has changed dramatically in the last 10 years as it pertains to banking, as everyone knows. And so this allowed us to do that as well. Today, we are a division of United Capital Funding. We are bank owned, and we are thrilled to be a part of their organization. Factoring is not regulated. Being part of a bank affords us some regulation, and it's been wonderful for both the clients as well as our employees. The fact that the industry is not regulated is important because it puts the burden on the borrower to really identify who you're doing business with and what the structure is. We'll keep going here. This is a little bit about our team. Ivan Baker's the gentleman I referenced earlier, one of the founders of United Capital Funding. But you can see we've got people in Nashville, Chicago. I've got a great team. So if anyone needs a resource outside of Central Ohio, I can certainly introduce you to a trusted partner. Okay, a little bit about factoring. I always open with the statement that this is a strategic form of financing. It is one of the oldest forms of financing, dates back to Babylon. I mean, it's essentially just trade finance. So why is this so commonly misused or misunderstood or poorly structured? There are lots of variations to factoring out there. And so it is important that you, as the business owner, identify, okay, how is this structured? Who is the lender? How are they funded? And how will this take me to the next level in my business? And then how do I exit this program when it's time? So here I say, of course, it's up to the borrower to be proactive and prepared. The last thing you want to do is rush into this when you've got to make payroll on Thursday, right? You've got to select the right lender and the appropriate structure, and we'll talk a lot about structure today. And then you've got to take ownership of the outcome and really be prepared for the exit. You'll hear in circles, people will talk about that factoring trap. And that's when you can't get out of the cycle. You have to have an exit strategy. And working with advisors is really a great solution to that because proper planning makes all the difference. So when used properly, factoring effectively can finance the growth. It can improve your cash conversion, improve efficiencies, reduce the risk of bad debt loss or write-offs. It can balance out seasonal fluctuations, and it can provide access to much needed liquidity. And we'll go into more detail about each of those. In fact, I'm going to make a note to come back to that slide because I think that's an important aspect there. Okay, so how does it work? In short, factoring by definition is the purchase of an asset or an account receivable at a discount. So if someone is just a straightforward spot factor, they're going to buy an invoice at a discount. So for example, if you have a $10,000 invoice, the factor may buy that invoice for 80% of the invoice value or $8,000. Let me see if I can move this here up front. And then the factor will collect directly from your customer. They're just buying the paper in that scenario. Now that factor may collect a full $10,000, the full value of the invoice, or they may collect $5,000. They may have to take a loss on that. That is spot factoring. It's a one-off. It's not something I have ever offered because it serves a very specific one-time purpose. My company, my firm, is rooted in the relationship and solving a problem to get to the next level in your business. But this is an option and people do utilize it. So there are different forms. Whoops, jumped ahead there. Spot factoring, which I just described. There are also specialists. So you can work with a factor who may specialize in healthcare, construction, transportation, for example. It's important to work with a specialist because there are a lot of benefits to working with a specialist. They may have tools, resources, connections that can benefit you. And as the business owner, you should be able to leverage those and work with a trusted partner who will help you utilize those resources. Also government. There are specialists who can focus on government lending as well. We at Capital Plus are a generalist. we focus on converting invoices from the credit and collections phase all the way through collection and payment processing reconciliation. We work with everyone with the exception of healthcare, construction, or transportation. We do have specialists who we refer to who are well respected in the industry. We do work with government entities, so that's good. What we are not, factoring is not PO finance, asset-based lenders, and I'll go into the difference there, or the daily debit lenders. A PO finance company is going to take the purchase order on the front end, and they're going to advance a portion of that, and they're going to control the goods from, say, the manufacturer to the end customer. And then once the goods are delivered, then the PO becomes an invoice, and a receivable finance company or a factor will take out the purchase order finance company. It's more expensive, but it does solve a purpose, right? If you're getting into a new product, for example, we worked with a lot of PO finance companies during COVID for companies that may have gotten into PPE, and the PO finance would help get the initial few orders off the ground, and then we come in as the factor. Asset-based lending is similar to factoring. They do oftentimes place great emphasis on the accounts receivable, but they can also lend against inventory and equipment. Typically, those deals are bigger deals. Factoring can be very well suited to smaller businesses that are growing rapidly, but their largest asset would be accounts receivable on their balance sheet. Daily debit lender, that's a term that I use for often you'll hear MCAs, merchant cash advances. They're going to offer you quick access to money, and they're going to debit your account. We can do a whole series on that, on those. Be very cautious anytime you borrow, from who you borrow, how they're going to be repaid, and how you exit that structure, especially in particular to daily debit lenders. Okay. All right, how it works. Let me move this again. Okay, so essentially in factoring, the client will receive the order, the client being the business owner. The client delivers the product or the service as agreed to their customer. The client then invoices their customer and copies the factor. The factor, if the client needs additional cash, the client has the option to take the advance against the invoice. And it depends on your industry. Retail, for example, if retail has a high credit memos or high deductions against their invoice value, you may see a lower advance rate. But typically advance rates will range between 70 or 95% of the invoice value. In transportation, for example, we're seeing about a 90 or 95% advance in that industry across the board. So it really depends on your industry and what type of invoice you're presenting. But you'll see you have the option to take an advance against that invoice. And then the factor would collect directly from the customer. Customer pays the factor, and then the factor will deduct their fee and recover their advance and remits the remaining amount to the client. So you can see our little diagram over here. You receive the order, you deliver the product or the service, you invoice your customer, copying the factor. Once the factor collects from the customer, the factor will recover the advance and any fee associated with having that money out, and then will release what's called the reserves to the client. So that's the flow of the transaction. I just want to make sure I'm not missing any questions. So feel free to raise a hand, or Sharon, if you can help me if I miss anything, that'd be great. I just don't want to miss any questions. Okay, now when I talked a little bit about the specialists and the types of factoring, you can work with someone who just buys paper, like a spot factor, or you can work with a specialist who would typically provide additional services like invoice management, credit and collection support, and things of that nature. Now that's going to come into play usually really through this whole cycle. And when we started at the beginning of the presentation and talked about some of the benefits, one of the benefits was it improves that cash conversion cycle. And when I say that, I mean from the time you take the order and you're investing money in either people with payroll or goods to provide the product, your cash conversion cycle is very important to keep that streamlined, because that allows you to make more widgets or place more people, right? So once you receive the order, if this order is with a new, well, hopefully you would do this before the new product or new customer comes on board, but you can utilize your receivable finance or factoring company to do credit evaluations on your existing and prospective clients. Your sales team can say, hey, I'm calling on this company tomorrow. I'm wondering, are they really going to pay me in 30 days? Because if they agree to pay you in 30 days, but actually pay you in 45, that's important to know prior to pricing the product or the service, right? So you can use these ancillary services to your benefit. That's one of the reasons to consider a strategic source of working capital like this, because it's far more than just a line of credit. It can be far more than just an advance on your invoices. So you can use them for credit evaluations on current and prospective clients. You can use them for professional collections efforts, right? For example, I have a great new client who came on board, and she's rapid growth staffing industry. She came to us because she is new in business, only been effectively billing customers for about a year, was on the verge of $1 million in annual revenues. That's top line revenues, right? Rapid growth. And she said, okay, I have a number of customers who aren't paying me. They're not taking me seriously. So we have a professional collection specialist who will go and advocate on her behalf and say, look, you agreed to these terms. You are past due. I'm the squeaky wheel on her behalf. And we help her effectively turn those receivables more efficiently and reduce that bad debt right off. So this is one of those, when I say a strategic use of a strategic source of working capital, this is what I'm talking about. You make your source of working capital work for you. Credit evaluations, professional collections, let them be the squeaky wheel. Invoice follow-up and oversight. If an invoice is one day past due and you're not actively calling on it, that gives the customer the mental permission to delay payment, in my opinion. If you're that squeaky wheel, I mean, this is your money, you need to collect it. And if you don't have the time to collect it, have someone else do it for you. And a lot of times it's very difficult to be the business owner and the collector, right? So it helps, in my opinion, to outsource that in many cases. But again, it's important to work with someone that you trust, because you're outsourcing some of that customer relationship. So you have to understand, how are they going to engage with your customer? And is it in a manner in which that you want them to engage? Is it professional? Is it courteous? Are they effectively turning my invoices? Right? All good questions to ask. Okay, full access to your AR aging via client reporting platforms. Okay. Oh, and payment processing and invoice reconciliation. So essentially, just like you would outsource your payroll, you can outsource your credit and collections processes. The invoice reconciliation, I mean, a lot of people aren't paying with checks, but you would be surprised how many checks we still receive in our office. And I mean, with mobile apps, you can deposit those checks quickly, right? So payment processing, we do for our clients. And really the benefit there is the invoice reconciliation. We're always, whether the customers use portals or even if they're using their own software platforms, we're helping our clients keep their agings clean. And if your accounts receivable is the largest asset on your balance sheet, it's very important to keep that clean. I'm sure everyone at MBAC would agree with me on that. Okay. So some of the results to these ancillary services are you reduce your loss or risk of loss due to bad credit decisions, right? You're improving your invoice turnover. The longer an invoice goes unpaid, the less likely you are to collect in full. Streamline cash applications. You can benefit from some of the software that these factors are using, and the software just keeps getting better and more interactive. You can reduce expenses associated with the credit and collections function. We work with a number of manufacturers who came to us and said, hey, look, Susie at the front desk runs our invoicing. She gets the invoices out, but she hates making collection calls. We can do that. You know, Susie turns over, that position turns over, and with every turnover, it causes delay in collections. You can avoid that by outsourcing it to a professional group if you select the right factor. Now, if that's not important to you, there are many factors out there who will not provide that service and don't charge for it. So that may be a better fit for you. Again, I go back to the importance of doing your homework and evaluating different structures. The reporting at your fingertips, we're all used to that, right? We want it immediately and on our phones. And typically we can, a factor has that ability to do that. Now, really, this is all caps because that balanced cash flow is so important. When I talk about balanced cash flow, I mean cash flow that is balanced, not that you're borrowing on every day or not that is delayed, but balanced. You have control over that cash flow cycle. You choose when you take advances, you look at a clean aging, and you know when invoices are coming in. Oftentimes factoring is associated with borrowing on every invoice, and you're borrowing from Peter to pay Paul. That should not be the case. There are lenders out there who will do that. In my opinion, that's not how factoring should be used, or you will end up in that factoring cycle that it's difficult to exit. So factoring should, in my opinion, be used for that, achieving a balanced cash flow, a clean aging, access to capital, invoices that are turning. Okay, so that access to capital. Typically, we're seeing 80 to 90% advance rates. I did note earlier, retail, you may see a lower advance rate. Transportation, you may see higher advance rates. Advances are available at typically anytime that an invoice is current. Now, that current may be 30-day terms. Your industry may have 45-day terms. As long as an invoice is current, you can typically take an advance. Now, that's important, because if you take an advance on day one, that advance may be out 45 days. You're using the money for 45 days until the customer pays. Now, if you take an advance on day 30 and the invoice is paid in 45 days, you will only have the advance out 15 days. These are typically tied to the days that an advance is outstanding. So imagine a world where your invoices are turning, your aging is clean, and when you need to borrow, when you need to access liquidity, you access your aging and you look, okay, what invoices are due to be paid relatively soon in the next 15 to 20 days or 10 to 15 days. You look at a clean aging, low credit risk, invoices that turn. You have a professional staff helping you turn those invoices. And you say, okay, I can reasonably expect these invoices to be collected in 15 days. I'm going to draw on those specific invoices. And now the business owner is not only fine-tuning that cash conversion cycle, but also strategically borrowing specifically on certain invoices. So it really does create that balanced cash flow. Okay, fees are based on risk. So again, factoring is not regulated. If you are in a high risk industry and you don't want to assume any credit risk, you can pay more for the advances and the factor will take on additional risk. Lots of variations to this, lots of structures available. So we can get more into that here as we move on, because there are different nuances here. Credit limits are established in large part based on the credit worthiness of the customer. This is super important. If you are a new business, for example, one of my newer clients I mentioned earlier, she's only been in business about a year. If she were to go to the bank the bank would look at her historical financials, which are only 12 months, right? And they're going to say, okay, you only have 12 months of historical financials. I can't reasonably predict what you can repay from the business in terms of debt. So I'm only going to give you, if anything, a small percentage of availability, and we're going to tie that to your personal credit, right? So I'm going to give you maybe $50,000. Well, a rapid growth company is going to burn through $50,000 pretty quickly and may not be able to revolve that as quickly as the bank would like to see. So while the bank is a wonderful source of capital for a rapid growth, newly formed business, it's important to consider factoring, because the factor will not look at your historical performance. They will look at the credit worthiness of your customers. What is the contract you have in place with them? What service do you provide? And is the customer credit worthy? If they can reasonably assess that, then they will set a credit limit based on the transaction, essentially, and not based on the client's historical debt service capabilities. So if you have questions on that, let me know. It's important to understand that. Okay, so who is this a good fit for? I really love factoring for rapid growth companies. It's also very well suited for recovering companies, pre-bankable, venture capital, angel seed investments. We work with a lot of VC-backed companies who may be in between seed rounds, and they don't want to go back to their investors for more money. They want the company to fuel its own growth and fund organically while preserving their cash, perhaps investor funded. It's also a great fit for someone who is a seasonal business, so they can borrow during that buildup phase to address the seasonality. So those are really good examples of a company that could benefit from factoring. It's not really industry specific, but as I mentioned earlier, if you are in medical or construction, by medical, I mean healthcare staffing, it's often ideal to work with a specialist, especially if you're billing Medicare, Medicaid. Just as I provide a whole host of ancillary special services to help my clients turn their receivables and keep an aging clean, those industry specialists also do that, but they have specific knowledge to the industry that can benefit the borrower, the business owner. You do have to have credit-worthy account debtors. If you're doing business with mom and pop businesses that we can't establish a credit history for, it's going to be hard to get that, to get a line against that, or availability against that, I should say. Factoring works with companies well above 25 million in annual revenues. However, once you get up above a certain level, typically you can work with an asset-based lender who will also lend against equipment and inventory, and they'll do it in a manner that is a little more easily accessible to those larger companies. We like to see gross profit margins upwards of 20%. And the reason we do is because we don't want to erode the profitability of the company. It's important to keep these costs in mind as you engage any financial partner. And we have found that if you have gross profit margins above 20%, it is a much better outcome long-term. Now, factors also do file a UCC filing. This is super important. Business owners I know today do not consider this as often as they should. A lot of times they'll take an online lender, they fill out the application, they click through and agree, and next thing you know, there's a lien on their business. That lien is important because now the lender has said, okay, the assets in your company belong, I have a lien on those assets as a lender. Now, if you were to go work with a bank, or you want to work with a financial source like a factor, they're going to pull a lien search and they'll see that someone else has first priority. And that will limit your ability to leverage those assets. So it's really important to understand who's filing a lien on your business and what is the collateral description. Okay, so I know I'm giving you guys a lot of information. We can take questions. when you work with a factor and you're in that, let's say 10 million in annual revenues and under, you will be faced with options, notification or non-notification. Now, the factor will run a credit evaluation on your customer. If the customer is approved and you engage the factor will likely notify the customer of the relationship. That's called notification, and it is a legal notice to the customer or debtor of the assignment of the receivable. Now, this letter can vary greatly. It can be, hey, let's say you work with Walmart. Walmart, you are notified that ABC company has sold the rights of their receivables to ABC Factor. Now you are notified to pay ABC Factor directly for these specific invoices. In our company, for example, when we notify, it is not the debtor or the customer's information as to what invoices have been advanced against or not. Many of our clients do not advance on the majority of their invoices. They use us for those services and then advance strategically when and if they need the cash, right? So our notice, just to give you an example of the variations of the notice letters here, our notice letter says, hey, ABC company has hired Capital Plus as an outsourced AR management and finance company. Please pay ABC company care of Capital Plus at this address and banking information. So I share both examples because it can be a legal notice that says, hey, ABC has sold the rights of its receivables, or it can be, hey, ABC company has engaged an outsourced AR management and finance. It legally serves the same purpose. The language, there's the legalese in there that is required. But my point is, you as the business owner need to understand, is this a notification or non-notification relationship? And what does that notification look like? Non-notification is harder to obtain and it costs more. In fact, it's harder to find at the smaller levels. Once you get up above that 10 million, 25 million in annual revenues, and you're looking more at a borrowing base, maybe an ABL facility, that's going to be non-notification. But when you're working with smaller businesses, it's typically notification. Recourse versus non-recourse. Okay. Recourse means if you sell me an invoice, a $10,000 invoice. Full recourse means if that invoice goes unpaid by your customer, you as the business owner and borrower will repay me as the factor the advance and any fees associated with that advance. Okay, so full recourse means that the borrower is fully responsible for repaying any advance and fees on all invoices. Non-recourse is when the factor assumes all of the risk. Okay. Now, if it is non-recourse, the factor will say, okay, I've evaluated the credit risk. I've got the invoice. I'm going to pay them it's a $10,000 invoice. I'm going to advance the borrower $8,000. And I assume as the factor, non-recourse, I will assume the full credit risk. If that invoice goes unpaid, I as the factor am at a loss. I do not look to the borrower to recover my advance and fees. It's my responsibility to recover the advance and fees directly from the debtor or the customer, okay? There are modifications, of course, to that. So there is another structure called modified recourse, where the factor may assume credit risk only, but if an invoice goes unpaid due to service issues or a dispute, then the borrower repays the factor for the advance and fees. So just as you have variations with notification or non-notification, there is also recourse, modified recourse, or non-recourse. You will see quite a few factors offering non-recourse today. Typically, there will be perhaps a lower advance rate because there's higher risk, but you do see quite a bit of non-recourse in the market today. Collateral. Collateral, as I said earlier, factors will file a UCC-1 on the business. That UCC-1 can include all assets. It can be just the accounts receivable, or it can also be specific accounts receivable. So there are times where we'll have a banking client come to us and say, hey, I love my bank, I'm working well with them, but this particular customer of ours is delaying payment. And the bank now has excluded that from our borrowing base. We can come in and say, okay, let's see if we can turn those receivables quicker, and we can provide availability against that in order to give the client some additional working capital, and it relieves the bank of that. Maybe that became an outlier on their covenant requirements. So anyway, that's probably too much information for this one. If you have questions on that, I can talk about that as well. Okay. Let me see here. I know I've given you guys a lot, and let me check the time. It's 11:40. So let's see if anyone has any questions. Let me see if I can pull this up so I can see the chat.
Great. And panelists, I'm sorry, our attendees, if you would like to speak directly with Renee, we can allow you to unmute yourself. So just let us know, and then you can pose your question without having to type it.
Okay, one thing I can do is I can go back. Oh, good. Did you stop my screen share?
No, I didn't. You should be able to turn it back on.
Okay. Well, here. There we go. Let's go back here. If no one has any questions, I can focus just a minute on some of these benefits, because what I really like to see, oh, I see something in the Q&A here, and then I'll come back to this. Does the factor require payment direct from the customer? Thank you. That's a very good question. I feel like every question has the answer. Well, yes, but there are options. Typically, yes, the factor does require that the customer pays the factor directly for the benefit of the client. So, Lynette, for the purpose of this conversation, the business owner, the borrower, is the client. The customer will be the debtor. Okay, so the client says, yes, I'd like to advance, or no, I don't want to advance. Either way, all of those invoices for that customer will be paid through the factor. And the factor can clear the reserves on a regular basis. Let's go back to this slide here. So as the customer pays the factor, the factor has a number of options. Some of our clients take their reserves on a daily basis. So as payments come in, they're continually getting money from the factor to their account. Other clients are more strategic, and they say, okay, I know that I have payables going out on the 15th and the 30th of the month. And so I'm going to strategically get my reserves and my advances on, say, the 10th and the 25th of every month. And so they're controlling and establishing that balanced cash flow. As payments come in from the customer to the factor, that creates reserves. So the payment comes from the customer, we apply it to the invoice, we deduct the advance and the fee, and there's that remaining, let's say, just for simplicity's sake, if it's a $10,000 invoice, we advanced $8,000, let's say the fee was 2%. We are going to collect from the customer, we deduct the $8,000 advance, will deduct the 2% fee, and then the remaining 8% gets paid directly to our client. Now, there are typically wire fees, so, or ACH. So we always encourage our clients to balance that cash flow and establish days where they know, okay, I've got payables on this day. And so I'm going to plan to get my reserves and take my advances on this day in advance of the day that my payables go out. See if I miss anything else. One last note on the customer payments. Because we do, some factors require that a client advance on every invoice or a minimum advance amount on a monthly basis. We do not do that, but we do require that a client send all invoices per customer through our system. So for example, if your debtor is Walmart and you've got 10 invoices going through our system, and you've got 5 additional Walmart invoices going through your system, when we're calling to collect on those invoices, if we're only collecting on 10 out of the total 15, it looks unprofessional, it's inefficient, it causes errors. So in addition, there would be 2 different remittance addresses, right? So that doesn't work either. That causes confusion. We require, if a client wants to have the option to advance against a customer invoices, we require that client submit all invoices per customer and change the remittance address. Okay, that's part of that notification letter. The notification letter will specify, ABC company has hired the factor to manage accounts receivable as well as finance against them. Payments now will all come to ABC company, care of Capital Plus at this information. So we effectively, as the factor, change the remittance instructions. In doing so, now all payments come through our system for that customer. Some clients will say, okay, I'm going to send you these 5 specific customers, but I'm going to hold these 5 out because I don't want you engaging with them. I want to handle those collection procedures myself. So they may not send all of their customers and just a few, but if you send a customer, we want all of the invoices per customer. Now, I always encourage our clients to send all of their customers, because if you're rapidly growing and you need the cash to finance that growth, you can strategically look at the whole picture, all of the receivables outstanding, and determine which invoices you would leverage for an advance versus only looking at, a lot of times people will come to me and say, hey, Renee, I'm working with this customer. They pay me in 90 days. I need to factor those invoices. But when we look at it, we say, okay, wait a minute, you've got this customer here paying in 30. Let us see what we can do to help streamline that 90-day payment, but advance against the ones that turn more quickly, because that's a better use of that asset versus advancing on the 90-day invoice and having it be out. You're paying for that money for 90 days versus the lower risk, which turns. So that's why I go, it really is a strategic tool, but it does require management. So we see the most success with companies who have an advisor, whether they're working with a certification program who also helps look at their financials, do some strategic planning. There are a lot of sources of capital out there, and we are just one option that can complement the others, but it does have to be used strategically, understood, and then exited properly. So let's talk while we're here. Oh, I see another question, and then I'll talk about the exit strategy. Thank you, Renee. Additionally, is there a benefit to strategically managing cash flow, transactions, remittances 2 times monthly versus daily or weekly? Well, personally, I think so, because if you're doing your payables and your transactions and your remittances daily, that is taking away from what I consider to be production, right? So if you, I don't know if anyone is reading Atomic Habits. If you haven't picked up Atomic Habits, I would highly recommend it. I'm a big advocate of structure and discipline in terms of getting stuff done, right? So in my own day, I have a schedule that I try very hard to stick with. Even as a business owner, I tried very hard to stick within my calendar so that I knew, my task list would get done. Payables and receivables should be the same way. So there should be a system to it. You want to preserve that cash, right? A lot of times people come to us and say, oh my gosh, I got to make payroll Thursday. And I've used all of my rainy day fund. I even took a line against my home and I burned through that before I sought out a working capital solution. Preserve your assets, preserve your rainy day fund, leverage these receivables, manage your payables, manage your receivables, set a plan and stick to it. If you're doing it daily, then you're always scrambling and trying to fit that in. I recommend setting a structure. Maybe it's 2 times monthly, maybe it's 1 day a week, every Monday or every Friday, to reconcile your accounts and plan for your cash out and your cash coming in. Work with your resources and your partners and your advisors to really understand that flow, because that flow can fuel your growth, and controlling that flow can fuel your growth. Factoring can be a resource and a help, or it can just be a hindrance. If you're scrambling every day and managing cash in and cash out, and you're like, oh my gosh, I got to make this, so I've got to just take an advance on that invoice, and you're not thinking, well, when is that invoice coming in? When are these payments due? It requires being managed. And if it is managed properly, it can really fuel sustainable growth versus just provide access to cash. I really like to see our clients work with advisors who help them manage the cash in and the cash out of their business. And when they're not working on the receivables and the payables, they're generating production. They're producing more widgets. They're selling more hours, right? So I am a big advocate of structure and working within those disciplines. I'm sorry, I know I'm being a little long-winded. I hope that answered your question. Let me just make sure. Yes. So in order to balance cash flow, I believe firmly in setting a structure, whether that's 2 times monthly or weekly. I am a huge advocate of that. In some cases, it will require daily, but what I don't like to see is scrambling. So I hope I answered that. Okay, so let's go and talk briefly about the exit strategy. If you do not have a plan, if you do not manage the factoring cycle, then you can get lost in the factoring trap. It is no different than a kid with a credit card. If you spend too much and you rack up that balance, it's really difficult to get out from under that debt. If you borrow on every invoice, and every invoice gets paid smoothly and you have no issues, then fine, that's not a problem. As soon as one invoice gets delayed and the factor says to you, hey, this invoice is out 95 days, we need to recover the advance and the fees associated with the advance from your next advance. Well, you may have needed that next advance to meet payroll. Now you're behind. So this goes back to, Lynette, your question of managing, whether it's daily, weekly, or 2 times monthly. If you really do need to manage those payables and know your cash coming in and plan appropriately, because if you're borrowing on every invoice to make that next payment, then as soon as one thing goes wrong, it's like that house of cards. So in order to avoid that, you need to be strategic and very carefully balance the cash in, the cash out, and leverage the resources. And you should be advancing less frequently as the growth subsides and stabilizes a little. So that's a lot of information. I hope it was valuable and helpful information. I'm going to go back to this slide just so that you guys have my contact. Actually, this last slide might be the best one. Oh yeah, you can find me on LinkedIn, and my email address is very simple. It's just renee@capplus.com. I'm super happy to help and answer questions. If you are in the industries of construction or healthcare or transportation, while I can't finance you, I can certainly get you in the hands of a trusted partner. So I can answer any questions, and you can certainly reach out to me directly, either via email or on LinkedIn.
Great. Thank you, Renee. This has certainly been informative. Yeah, it's a lot of information, but I think the concept itself, is simple enough. And hopefully everyone that's on the call has gotten their questions answered about how they can utilize this resource, to free up that cash flow and to how to, make sure that they can meet their business needs. Again, thank you for sharing this hour with us. And Renee, once again, we appreciate you. You do have her contact information, and if not, just reach back out to us as well. We'll put you in contact with her, because if this is something that you're interested in doing, I'm sure she'll be able to speak to you more directly with regard to what you specifically need for your business. Okay. So again, thank you for your time today.